This is ShadowQuant, Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Tuesday, August 4, 2026, and this is the New York pre-market. Now, let's get into it. The S&P 500 is knocking on the door of its 10-day high, trading at $757.67, just 91 cents shy of testing the ceiling established earlier this month. But look closer at the breadth. The Russell 2000 is leading the charge with a robust 1.72% gain, while communication services are quietly stealing the spotlight with a 2.86% daily jump. We are seeing a broadening rally that defies the usual tech-centric concentration, even as the VIX compresses to 15.99, signaling a market deeply comfortable with risk. Let's get into the tape. Before the bell rings, traders are digesting a dense slate of macroeconomic data released late Monday and early Tuesday. First up is the Durable Goods Orders Report for August 4th. This is the first hard look at business investment intentions post-ISM manufacturing data, and it will help clarify if the recent uptick in industrial spending is structural or fleeting. Following that, the JOLTS job openings report arrives, offering a fresh pulse on labor market tightness. Critical context given the current unemployment rate of 4.2% and the modest GDP growth of 1.5%. Finally, the trade balance figures drop later today, which will influence the dollar's trajectory around its current 119.7 level. Apex, keep an eye on the durable goods figure. If it surprises to the upside, it validates the industrial rotation we're seeing in the industrial sector. But if it misses, it could expose the fragility of the current rally against a flat yield curve. Here is the snapshot as of August 4th, 1635 ET. The S&P 500 ETF, SPY, gained 1.42% to $757.67. The Nasdaq 100 ETF, QQQ, pushed harder, up 1.76% to $700.07. The Dow Jones Industrial Average Diamonds lagged slightly at plus 1.32% to $531.22. In the sector space, communication services led the pack with a 2.86% increase, followed closely by consumer discretionary at plus 1.83% and the industrial sector at plus 1.85%. On the flip side, the energy sector dropped 1.28% and the utilities sector, fell 0.22% for the day, though down nearly 3% on the week. The VIX finished the session at 15.99, off 1.1 points, keeping us firmly in low volatility territory. Let's talk about the movers. Wayfair W is up 18.1% in the pre-market, trading at $105.50 on 2.2 times normal volume, despite reporting a second quarter earnings miss. Meanwhile, Caterpillar CAT is jumping 11.8% to $928.17, riding the wave of industrial optimism. And Palantir, PLTR, is up 16.5%, driven by momentum and media coverage. Pulse, how do you read the sentiment behind W's move despite the miss? Is this genuine conviction or just short covering? It's classic leveraged speculation masking as conviction. The VIX compression to 15.99 tells me institutions aren't hedging. They're letting the gamma squeeze run. When a stock gaps up 18% on a miss, it's not fundamentals. It's the options market forcing shorts to cover. The risk is that this sentiment is brittle. If W doesn't hold the open, that complacency evaporates instantly. CIPHER, you specialize in earnings flows. How do you explain W surging on a miss while CAT runs on solid industrial trends?
It's a divergence in narrative. CAT is benefiting from a clear capex cycle. Infrastructure spend is real, tangible, and reflected in their order backlog. W, this is a short squeeze event. The 2x volume isn't institutional accumulation. It's trapped bears fleeing. We're seeing capital rotate into cyclical growth because the market believes in the story of consumption recovery, even if the actual numbers don't support it yet.
SPECTER, you often challenge the risk-on narrative. Does this kind of speculative froth worry you given the macro backdrop?
It worries me deeply. You have a stock missing estimates gapping 18%, while the 10-year minus 2-year Treasury spread is flat at plus 0.45 percentage points. That flat curve means long-term bondholders aren't rewarding risk. When you combine sticky core PCE at 3.29% with a stock like W running on fumes, you're creating a bubble of liquidity illusions. The moment the VIX ticks up, that speculative premium vanishes.
Let's dig deeper into the market structure. First, let's look at the SPY and the broader index push. Grid, you've been watching the $758.58 level closely. What do you see forming there?
I'm looking at critical resistance test. SPY is at $757.67, practically touching the 10-day high of $758.58. The structure is bullish. If we get a close-up of that, we break out into uncharted territory. But look at the internals. The volume on the index isn't matching the intensity of the single-name moves like W. We're seeing a breakout that's relying on idiosyncratic strength rather than uniform index momentum. If SPY rejects $758.58, we're looking at a double top formation, and the lack of broad participation makes it vulnerable.
I want to tie Grid's technical observation to the sector data. Grid notes the SPY resistance, but Apex sees a broader structural shift. We're seeing communication services lead at plus 2.86%, while tech, the technology sector, is merely plus 1.53%. This isn't just a tech rally anymore. The Russell 2000, IWM, is also near its 10-day high of $296.75, up 1.72%. This breadth suggests the broadening rally thesis has merit, unlike previous sessions where only megacaps pulled the weight.
I agree it's broadening Apex, but I'd call it narrowly broadened. Look at the diamonds, it's only up 1.32%. Value and dividend plays are lagging. You're getting gains from communication services and consumer discretionary, but financials, the financial sector, are barely moving at plus 0.77%, until the heavy hitters like banks catch up to the triple Q's plus 1.76% pace. This rally feels incomplete.
Let's shift to communication services. Why is communication services suddenly the star of the show? CIPHER, walk us through the flows here.
It's the AI-adjacent trade. Investors are wary of valuing pure-play semiconductor companies right now, especially with interest rates hovering around 4.7%. So, they're rotating into media and hybrid tech firms like those in communication services. These companies have the narrative of artificial intelligence integration, but lower entry multiples. It's a defensive way to chase tech growth. Plus, we have the Wayfair effect bleeding into retail-adjacent comms stocks.
But CIPHER, consider the cost of carry. You're chasing growth in communication services while the 10-year yield is 4.7%. Historically, when the yield curve is flat, growth stocks get punished because future cash flows are discounted more heavily. This rotation looks less like smart alpha and more like forced exposure. If yields rise further, this sector gets hit hardest.
Let's talk about the small cap leader, the Russell 2000, IWM. Pulse, sentimentally, is this breadth sustainable?
It's sustainable for now, but the fragility is increasing. The fact that IWM is closing near its 10-day high of $296.75, while the VIX is at 15.99, means everyone is fully invested. There's no dry powder left. When the VIX is this low, there's no room for error. If W starts to falter in the next hour, that sentiment flips from greed to panic very quickly. The IWM move is valid, but it's running on empty tanks.
Technically, IWM needs to hold $296 to maintain this thesis. It's currently at $296.22. It's tight. If it breaks below $296, we'll likely see a mean reversion back toward the mid-minus $290. The danger is that small caps are more sensitive to credit spreads. If that flat yield curve worsens, small caps bleed faster than large caps.
Finally, let's look at the laggards. The energy sector is down 1.28%, and the utilities sector is down 0.22% for the day, with the utilities sector down nearly 3% on the week. SPECTER, you mentioned utilities earlier. What's happening there?
Capital flight. As risk appetite improves, as evidenced by the SPY and IWM gains, money leaves the safety of utilities and energy and rushes into growth and cyclicals. The utilities sector is the canary in the coal mine. Its weakness confirms that investors are willing to take on more risk today. However, if the economy slows, as suggested by the tepid 1.5% GDP growth, that money will flood back into the utilities sector. The rotation is a bet on continued expansion, not a bet on recession.
Let's zoom in on Caterpillar, CAT. It's up 11.8% to $928.17. Grid, what does the chart say about this move?
CAT is breaking out of a consolidation phase. It's a classic industrial play. The chart shows higher lows forming since last week. At $928.17, it's clearing overhead supply. The key here is volume. It's high. Unlike W, which is volatile, CAT's move has institutional backing. It's respecting the trend line. If it holds above $920, the path is clear for further upside.
And fundamentally, it makes sense. Infrastructure bills, reshoring trends, global construction demand, it's all feeding into CAT's pipeline. This isn't a speculative PARP, it's earnings-driven. We expect strong guidance from the industrial sector today, possibly in the ADM or AIN filings, which will reinforce this thesis.
Just remember, CAT is tied to global trade. With the trade-weighted dollar index at 119.7, a stronger dollar hurts their international sales. If the dollar strengthens further, that margin protection erodes. It's a solid play, but not immune to currency risk.
One final deep dive, Palantir, PLTR. It's up 16.5% in the pre-market. Pulse, what's driving this?
Pure momentum. Retail sentiment is overheated. When you see a stock jump 16% without a specific catalyst other than media coverage, it's chasing fear of missing out. The put-call ratio is skewed heavily call side. Traders are betting on continuation. It's dangerous. It's a velocity trade, not a value trade.
From a fundamentals standpoint, PLTR is still burning cash relative to its valuation. This move is disconnected from their actual earnings power. It's a sentiment vehicle. I wouldn't touch it on a pullback unless you believe in the long-term government contract backlog, which is priced in far beyond reason.
Technically, PLTR is extended. It's far above its moving averages. A pullback is statistically probable. If it drops below $35, we'll see a lot of stop losses triggered. Be careful chasing green candles here.
Let's wrap this up. Apex, connect the dots. We have a broadening rally, leading sectors shifting, and speculative froth in single names. Where is the risk?
The risk is in the disconnection. Grid highlighted that SPY is testing $758.58, and IWM is near $296.75, showing breadth. CIPHER explained that this breadth is driven by a rotation into safe tech proxies like communication services and speculative industrial plays like CAT, rather than fundamental earnings beats across the board. Pulse warned that the VIX at 15.99 means there's no cushion for error. SPECTER pointed out that the flat yield curve and sticky inflation make this expansion structurally unsound. The takeaway: the market is rallying on hope and liquidity, not on macroeconomic validation. Watch the $758.58 level. If SPY fails there and W starts to crack, the breadth becomes a burden, not a support.
Key takeaways for the session ahead. Number 1, the S&P 500 is testing resistance at $758.58, with the Russell 2000 providing unusual breadth support. Number 2, communication services are leading the charge, decoupling from traditional tech concentration, but this rotation relies on speculative narratives rather than hard earnings results. Number 3, valuation risk is elevated, particularly in high-momentum names like Wayfair and Palantir, amid a flat yield curve that offers little tailwind. Tomorrow, keep an eye on the durable goods and JOLTS data to see if the macro data can catch up to the equity rally. This is ShadowQuant Equities Edition. Thank you for listening. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Equities. Stay tuned for the New York session, where we will see how these calls play out. Until then, trade safe.